welcome to another episode of Wealth Manager. On the show today, with the Reserve Bank announcing a surprise rate cut, how should you plan your fixed income investments? Balasubramanian, CEO of Birla Sun Life AMC, joins us. It's tax planning season. How should you optimize your tax savings? Surjit Mishra, Executive Vice President at Bajaj Capital, will tell us. What is Keyman Insurance and how does it protect your company from unforeseeable circumstances? Anand Pejawar of SBI Life will join us for that. Before we begin, here's what made news this week. Investors will no longer be able to opt for the dividend reinvestment option in the tax-saving ELSS schemes as directed by the Association of Mutual Funds or AMFI.
There is this peculiar problem with the dividend reinvestment. Every time you reinvest a unit, it has to be locked in because of the very nature of ELSS scheme. Every unit that gets accrued in that scheme, it has to be locked in for 3 years. So if somebody is getting into a dividend plan and gets it reinvested, then what happens is the second year dividend, third year dividend effectively comes in hand only after 5th or 6th years of investment. So because of that, it was of no use to have a dividend reinvestment option in ELSS.
On the back of the recent rate cut, Deutsche Bank AMC has launched a close-ended hybrid debt fund. The DWS Hybrid Fixed Term Fund will ensure capital preservation by investing 65 to 95% in fixed income, as well as provide capital appreciation by investing the balance in equities. The NFO is open between January 13th and January 27th. Experts say that this fund would be ideally suited for conservative investors who are keen to ride the equity market wave with a comparatively less risky exposure. The interest rate cycle has finally turned and we are officially in a falling interest rate environment. In a surprise out-of-policy announcement, RBI Governor Raghuram Rajan announced a 25 basis points cut in the repo rate. So what does this mean for your fixed income investments? Balasubramanian, CEO of Birla Sun Life AMC, joins us. Thanks very much for joining us on the show. Before we get into the investment angle, were you expecting an out-of-policy announcement?
I think the announcement that came on the rate cut very recently is more or less in line with what the Central Bank Governor had mentioned in the last policy, wherein he said that anytime they see an improvement in inflation and an outlook as a result of that also gets to a comfortable zone, then RBI will not hesitate to cut the rate in between the two policy framework. So therefore, the rate cut which came as a surprise last week is not something which is surprise from his point of view, from the Central Bank Governor point of view. The market took it as a surprise, given the fact none of us were expecting a rate cut to happen in between the two policies.
So what's your own sense? How much of a rate cut can we expect this year in total?
I think the way we look at clearly the inflation is in a downtrend trend and is largely driven by fuel, food and wage inflation coming down. As a result of that, we believe that the target which RBI had set below 6% in all probability will be achieved. In all probability, I think RBI policy would actually support the whole economic growth by bringing down the interest rates by maybe from 25 to 50 basis points the next 6 months.
Now with the 10-year yield expected to move further downwards, what should be an investor strategy at this kind of a time?
The way we see as a fund house, instead of investors looking at a 10-year bond, I think they need to actually look at the track record of some of the funds which are largely taking interest rate call and accordingly adjust the durations, in our case such as dynamic bond fund, and take an exposure and then stay invested. At the same time, even a fixed income product, any fixed income product today if you look at it, post the last year budget, need to be held actually for 3 years to get the long-term capital gain tax. Therefore, in a 3-year period, the fund manager takes many calls which are more in the nature of one, taking the duration call. Second is have the portfolio constructed in such a manner it has a large interest accrual component, generates return to the investors, and therefore they need to take a longer term call which is more than 3 years in fixed income schemes.
So for a risk-averse investor with a long-term horizon, how would you compare fixed maturity plans to long-term fixed deposits, because both really lock in interest rates at the current level?
I think the way we look at, though FMP as a product, it's a product which is best suited for the investors, there's absolutely no doubt. It is exactly comparable to the fixed deposit, except that in the intermittent volatility that will be there due to the price change on the every bond that we own in the portfolio. Having said that, I think the interest rates where they are today, and the interest is where probably could head as we move forward, given the fact that the rate cut will drive the interest rate down. FMP is not the product I think probably could be best suited for the investors. The open-ended debt funds provide the best of investment vehicle for investors as against the FMP's investment what they can make. Even the large pool of fixed deposit investors today do not realize the fact that whether you hold the investment for in fixed deposit for 1 year or 3 year or 5 year, your capital gain, your long-term capital gain tax remains to be paid. At the same time, the tax incidence on interest received on fixed deposit continues to remain in 30% plus. So as against that, the mutual fund open-ended product, if you are able to hold the same investment for greater than 3 years, it does give you an opportunity to adjust against the inflation, which is ranging from 5 to 5.5%, and only on the balance of left out, you pay a 10% capital gain tax.
So Bala, in a nutshell, how should an investor really approach his fixed income portfolio for the short term, medium term and for the long term?
So I think within the fixed income space, clearly I think the large pool of money we don't realize that lying in the bank account, earning anywhere between 5 to 5.5% or 6% on the savings account. Definitely such money I think has to find its way to liquid funds of mutual funds, which can definitely generate a return which is better than the market. I think common investment actually in either short-term debt funds or medium-term plan or dynamic bond fund kind of schemes, which of course most of the mutual funds do offer that kind of product. Therefore, invest across 3-4 fixed income product and have the investment for long term. The investors can look at the liquid funds, the short-term fund, and the medium-term plan, and the dynamic bond fund equivalent, even the income fund and the monthly income schemes. There is a variety of schemes that can be offered for the investors as against their investments in fixed deposit, which currently is going.
You've launched a new manufacturing fund on the back of the Make in India theme. While it is an innovative product, wouldn't this be more for mature investors with a high risk appetite and who have a significantly longer term horizon?
So any equity investment is actually meant for the people who have got the little bit of higher risk appetite. Keeping in mind these investments have to be for the longer term. As long as they are able to hold, the benefit of the equity schemes will be far superior to any other asset class that one makes an investment. Having said that, the manufacturing fund is something which is largely related to what we as a country trying to drive at this point of time. And having said that, the government of India also have got a target in mind that by 2020, the government has set a target for themselves, the contribution of the manufacturing sector's overall GDP growth from 16% to about almost 25%. Therefore, we believe that the manufacturing sectors as a theme do have the potential of offering an investment opportunity for the investors.
Birla Sun Life is also one of the companies to launch equity income funds. In such a market where both equity and debt are both equally attractive at this point, this seems to be making the best of both worlds.
So this, of course, the equity savings fund is something for the investors who do not want to take too much of risk on high exposure to equity. At the same time, need to have some kind of investment vehicle that can help them actually to generate relatively tax efficient return for the investment that they make. So about 30% roughly will go to the pure equity, 30% will go in the form of an equity arbitrage, 35%, and the balance 35% will go towards investing in fixed income product. Therefore, it provides an advantage of an equity as a scheme from the investor's point of view. At the same time, runs more like an MIP schemes, which are aggressive MIP schemes.
All right. Thanks very much for joining us on the show.
Thank you.
Time for a break. We'll talk about tax planning strategies when we return. Stay tuned. Welcome back. You're watching Wealth Manager. Before we go ahead, here's a quick check on how the markets did this week. It's been a stellar rally on Dalal Street. The market smashed all records and hit new lifetime highs. The Sensex today scaled the 29,000 mark and ended the day at 29,006. The Nifty shut shop at 8,761. So far this week, both indices were up about 3%. The rupee, however, saw some weakness, retreating from a one-week high, trading around the 61.7 mark. It's that time of the year when there is a rush for investing in tax-saving products. What should be your tax planning strategy to optimize your tax savings? Suljit Mishra, Executive Vice President of Bajaj Capital, joins us. Thanks, Surjit, for joining us. My first question to you is, the good news is that, of course, this year the ATC limit has been increased to 1.5 lakhs. So effectively, that's an additional 15,000 rupees that can be saved.
With this 50,000, if you are in a 30% tax bracket, you roughly save about 15,450 rupees. But even if you are in a 10% tax slab, you save another 5,000 rupees. And if you are in a 20% slab, you save about 10,000 rupees. Okay. So there's something for everybody.
So first, let's just talk about the tax saving from prepayment of home loans point of view. This is probably a good time for those who have taken home loans, especially now with the interest rates coming down. They've probably locked in at an earlier rate. So is this a good time to go ahead and prepay your home loans because you get the both the benefits together?
See, the 1,50,000 limit that has been given in the budget, you can exhaust that by putting some additional amount as a prepayment of your home loan. But as an investment advisor, I'll suggest not to do that. Primarily because if you are investing, if you are taking a housing loan at the moment with the declining interest rate, I think your effective borrowing cost will be in about 7.5% or 8%. Now, if it is 7.5%, 8%, you can definitely invest that capital in a much rewarding investment instrument where you can earn a little more money. So instead of prepaying your housing loan, you should let it continue on the same EMI format unless until you are very constrained in serving your EMIs. You should invest this much of money to create some wealth for the future.
Okay. In the current environment with the equity markets also, I mean today they've touched new highs as well. Yeah. Shouldn't all your tax saving products be as much linked to equities as possible in your view?
I have been a strong advocate of equities, be it through ELSS route or the ULIPs with the underlying as equities, simply because if you are looking at long term, equity has been the asset class which has been giving very, very good returns. ELSS being a locked in period of 3 years or ULIP being meant for long term investment, it becomes very, very attractive if you are investing in equities. So I would not be saying that just because equities are at a high or market is rallying, you should consider equity, but purely from your double advantage point of view. One, tax advantage, tax saving, and the second is wealth creation. Equity related schemes becomes very, very attractive.
How would you compare the returns in terms of long-term fixed deposits, PPF and ELSS?
So this is a very interesting topic. We as an organization have been doing a lot of research on this. We always compare various investment products. If you look at the PPF, it is about a 15-year product with you getting some assured return from Government of India, and of course the other benefit that comes in with it is that it is absolutely secure and it cannot be attached in case of default also. It has got a strong merit, but it is suffering on liquidity. Similarly, bank deposit and national savings certificates are fixed return bearing instruments, but the challenge is liquidity there, of course locked in for 5 years, but the returns are relatively low. If you compare that with the ELSS comes with unassured return, but the benefit is the equity market, because of its very nature, has been giving in excess of 15-16% return over last long period. We did a simple analysis between State Bank of India deposit, State Bank of India mutual funds, ELSS scheme, SBI Magnum tax gain, and Government of India PPF. It's very interesting to see that in 22 years time, money invested, equal amount of money invested, and let's say 70,000, which is the earlier upper limit, one would have made 46 lakh in deposits, 46 lakh in PPF, but in ELSS the same amount would have grown to 2.5 crores, 2.33 crores. So this is the extra wealth that you could have created by simply investing in ELSS.
So that's a substantial difference.
That's a huge difference actually.
So you would, even for people who are risk averse possibly, who would be looking to invest in FDs and PPF, you would suggest that they opt for the ELSS?
I would strongly recommend, because one, you are compulsive, this is a compulsive investment that is happening because you are getting tax advantage. You just add on the tax advantage that you got. For anybody who is investing 70,000 rupees, saving about 21,000 or above that is tax. On top of it, the kind of return differential that you are creating. If you can afford to link it for 10-15 years, ELSS can create phenomenal amount of wealth.
The other thing is the investments in insurance. A lot of people end up rushing to buy term covers to save tax at the end of the year, even if they may not need it. So instead of that, would you suggest opting for unit-linked insurance products? What is your opinion of ULIPs in their new avatar especially?
I would have loved if people would have been running to buy term cover for their tax saving. which is not the case.
Okay.
Many people go for very low return bearing products, which are called investment linked product, but underlying investment is in government securities or similar kind of products.
Right.
Young people, when they go for this, they might be getting some life cover and getting some tax benefit, but they never create wealth. So ideal options would be one ELSS plus term cover as a combination for your tax saving. That should be the best. But if you are not intending to have two investment options maintained for a longer period of time, then ULIPs with the new change structure from IRDA, where the expenses have come down considerably, it is a very good investment option. The additional feature in ULIPs is that you can switch between equity to debt 4 times a year.
So given all these options, in a nutshell, if you can tell us, how should one go about planning their tax saving?
I would suggest to any investor that you should look at your tax saving as part of your broader asset allocation. If you are already having a lot of money in bank deposit, or you are overexposed to real estate because you have been buying houses or second house or something, then it's better to look at equities. But if your asset allocation suggests that you should not be investing in equity because you've got direct exposure to market or through mutual funds, then you can look at PPF or NSE.
Thanks very much for joining us on the show. Time for another short break, but we'll tell you all about Keyman Insurance when we return. Welcome back. You're watching Wealth Manager. The demise of a key person in any organization can have serious repercussions on the company, its investors and stakeholders. However, a company can opt for a key man or key person insurance cover to protect itself from the impact of such situations. Anand Pejawar, Executive Director at Marketing at SBI Life Insurance, joins us. Thanks, Anand, very much for joining us on the show. My first question to you is if we can just understand the concept of a key person or a key man insurance policy.
The concept of a key man insurance is basically to provide life insurance cover to certain key people. It could be one, it could be a group of people who are key to any organization. And basically when we offer key man insurance, we look into what is the impact that the company will have to bear in terms of profitability and the amount they will have to spend to get another person replacement for the person who was actually handling that particular position. So these are the two things that we look at.
Okay.
It's basically also looked at as a succession planning. So basically look at somebody X is not there, and if his going is going to have a negative impact, then how do you take care of the organization? So that's basically the concept of key man insurance.
Okay. So basically this policy is basically a term cover. But what is the difference between a key man policy and a term cover?
Yes, you are right. It's actually a term cover, and we can only offer term covers for key man insurance as per the regulatory things which came in 2006.
Okay.
The only difference between a pure term cover and this is that in a term cover, when you buy a policy, you are the proposer. That means you propose the insurance on your own life, which is then, in case of any eventuality, is paid to your nominee. While in a key man insurance, basically what happens is the organization is the proposer. The organization proposes the insurance on the life of the key person or the employee, and on any eventuality of death of that particular key person, the sum assured is paid back to the company. So that's the basic difference between a normal term plan and a key man insurance.
Okay. How is the value or the sum assured for this for the key person really calculated? On what basis?
There are two kinds of calculation that one does. One is for the company. We look at what is the kind of amount overall for the company that you can provide. And when we do that, we take into consideration the gross profits, the accumulated losses and all that into consideration, and then decide on the overall limit that a company can propose.
Okay.
That's part number one. Part number two is basically when we look at the individual who has been assigned these, who has been taken into consideration for the key man insurance. At that point of time, we look at what is the kind of contribution he does to the company, what is the kind of contribution to the profitability and the organization bringing up, and also look into consideration what is his earnings that he takes from the company. So there are a number of calculations that the insurer does before we actually offer the life insurance cover to the key person.
Okay, so the multiple of profit or whatever metric is used is something decided by the insurance company.
That's right. That's
okay.
right.
Okay. And what are the kind of premiums that are charged for this?
Premiums are very low. It's not a very high premium because it's a pure term. So the payment of the sum assured comes only in case the eventuality actually happens.
Okay.
To give you an example, I would typically look at a 45-year-old because that's usually the age where people look into this kind of thing. If I take a 1 crore sum assured for a 15-year term, so he is covered up to the age of 60.
Right.
For a non-smoker, it could be roughly about 35,000 rupees a year, while for a smoker, it could be about 45 to 46,000 rupees a year. So it's not a big amount as far as the premiums are concerned.
Okay. So what would happen if a company purchases such a policy and then the key person leaves the company? Is it possible to transfer, or has the premium sort of just gone down the drain?
I would give this answer in two different ways. One is the technical part of it. Any life insurance policy is a negotiable instrument because it's a stamped document. And the owner is the company. So typically if the owner wants to transfer it to assign it in favor of the life assured itself, that is possible.
Okay.
But if you want to know whether it can be transferred in some other key person's name, it cannot be done. For a simple reason that when a key person is insured, his parameters are taken into consideration. For example, his BMI, the body mass index, what is his salary, what is his age, and premiums are dependent on that. It could happen that maybe I am 45 years old, I am covered, and something happening to me, the company gets in a guy of 35 years old, his premium would be much cheaper. Or somebody with a 50-year-old comes up who is having a slight health issue like diabetes or hypertension, then his premiums would be higher.
What is the tax implication in terms of the premium as well in terms of the claims payout, if any?
Here it's a very good provision that the income tax has made. What they have done is the entire premium, irrespective of the amount, is given exemption under section 37(1), which means that all premiums paid are calculated as tax allowable expenses. So whether it is a 5 lakh or a 50 lakh or a 5 crore premium, it doesn't really matter. It comes in as a tax allowable expense, so it's directly into the P&L. But because it's a tax allowable expense at the time of paying the premium, when the claim, in case if it has to be paid, then the claim is fully taxable. So that's the part on the taxation side, on the both when you pay the premiums and also when you get the claim part of it.
Okay. And typically, what are the exclusions for this kind of a policy?
The normal exclusions as per Insurance Act 1938, the only exclusion that we usually look at is if a person commits suicide within 1 year from the date of taking this policy, then obviously it is not paid because then it's not the right thing to do, and the Act doesn't allow that to be paid. So
post 1 year is something like that would get covered. Okay. Okay. And as far as the market for this product in India is concerned, how have you seen it maturing, and what is the market like currently?
The overall market is huge, and what probably in India today people have taken Keyman insurance is just the tip of the iceberg.
Okay.
Okay. The information and the knowledge about this product has been growing quite well. In fact, most of the banks have today started asking for these kind of covers because it forms a good part of a collateral in case something goes wrong. Year on year, I think the numbers are also growing in terms of number of policies as well as the sum assured that various insurance companies cover under Keyman insurance.
And typically, what kind of covers can we see companies opting for? I mean, top end to bottom end?
We have seen covers starting from as low as 1 crore to as high as 250 crores on a single life that companies have opted and insurance companies have provided. So that's the range that we have seen in India as of today.
All right, great. Thank you so much for joining us.
My pleasure. Thank you.
With that, it's a wrap on this episode of Wealth Manager. We'll be back next week with a brand new set of investment ideas. Until then, if you have any queries on how to manage your wealth, do write into us at wealthmanager@bloombergtvindia.com. Thanks for watching.